Hello, everyone. I'm Carrie Delgott, Wescott's Chief Operating Officer, and I'm here with Mark McCarron, our Chief Investment Officer. Great to see you, Mark.
Hi, Carrie. Good to see you as well.
Mark, this past Wednesday, May 25th, marked the 100th day of 2022 trading, but unfortunately, it wasn't a milestone that many are choosing to celebrate. It hasn't been a strong start to the year from a market perspective, but we will certainly want to spend some time on that today. Let's first start off with some of the most pressing headlines in the news. So, first, Russia's invasion of Ukraine doesn't look to slow down anytime soon, given the strength of the Ukrainian opposition. The latest inflation reports indicate some slowing, but consumers are experiencing significant price increases given high energy prices and the continued supply chain disruptions. The Fed's looking more aggressive with respect to raising interest rates given the 50 basis point increase at their last meeting. Additionally, the job market's experiencing strong wage growth, which is great for workers, but stressing some businesses given they are also feeling expense increases for many goods and services. And then lastly, the market volatility we've experienced this year has caused quite a bit of anxiety. But many say it may be overdue, coming off of the strong market performance from many years prior. So, Mark, why don't you kick us off by digging a bit deeper into this volatility we've been experiencing over the first 100 plus trading days of the year?
Yeah, thank you, Carrie. It has been a volatile start to the year. We wanted to put some of that performance volatility into some context. So what we have here is a chart over the last 5 years, since 2017, of the performance of growth stocks, value stocks, and the U.S. market as represented by the S&P 500. And I think it's important to understand the rationale or the reasons behind the market sell-off. And in our view, because this market sell-off has been driven by growth stocks specifically, that's represented here in the orange line. You can see that decline is much deeper, much faster than it is for the blue line, which is the value stocks. Our view is that it's been led by high expectation growth stocks being reset in terms of their prices and their valuations. And these are the same names that have been so dominant in the S&P 500 over the last many years. Facebook, Amazon, Google, Microsoft. These are the big large cap technology names that were in favor, as you can see in this chart, since 2020. Really, this is the pandemic and its recovery. But this is a valuation reset in our view. Value stocks, we're saying that because value stocks, if you look at that segment of the market, haven't really participated much in this decline. It's been a pretty modest decline, but it's been a pretty good and balanced return. And they've held up better in this environment because they're financial services, materials, energy, consumer staples. These are the names that tend to do better in higher inflationary environments, in higher interest rate environments. So we're going to get to that in a moment. But following this market decline, the S&P 500, which is represented here by the gray bar or the gray line, is trading at a much more reasonable 17.5 times earnings. And that's pretty significantly down from where it was a year ago. And that's a good thing for future returns because you're not pricing in so much expectation today for returns tomorrow.
Thanks, Mark. Now, the recent release of notes from the last policy meeting indicates that the Fed's still committed to a series of half percentage point interest rate increases. With that perspective in mind, let's get to the question at hand. Are we headed for a recession, or is this just a market reset, as you just mentioned? And how does inflation factor into that determination?
Yeah, everyone's watching the Fed. Don't fight the Fed is sort of a standard comment, right? And perception. And I think it's right. The Fed has indicated that they're going to be pretty aggressive in making sure that inflation doesn't become a problem. So inflation is the problem, right? That's what is driving the current volatility, both in the stock market and the bond market. And in our view, the Fed is focused on controlling inflation so that it doesn't become out of hand. Bond markets at the beginning of this year very, very quickly adjusted to the fact that the Fed's going to have to raise interest rates much more aggressively going forward. And that meant that the bond market was down this year, as well as the stock market, which is a pretty unique environment where you have bonds and stocks falling at the same time. But we've actually seen recently that the selling pressure in the bond market has eased a little bit. And I think there's a reason for that, and that inflation, at least expected inflation, may not be as high as what was first feared. And that would be a very good thing for financial markets in general. And we'll get to your question in a moment. Are we headed to recession? I think it's also a good thing for the US and global economy. So what we're showing here is a 5-year inflation break-even rate. What that basically means is it's the market participants' expectation of what inflation might look like 5 years from now. And it was spiking, from hardly any inflation to almost 3.5% inflation 5 years from now. And now it's dropped off. So this little decline here has given some hope for market participants in that maybe the Fed doesn't have to be as aggressive in raising interest rates as the market is currently expecting. And if that's the case, that reduces the risk of recession. So I think the market's concerned is that the Fed's going to go too far. They're going to raise very, very quickly and push the economy into recession, but they don't have to raise as much if inflation isn't as significant a problem as they expected. And it's really this is the question out there. And that's why the volatility is so high at the moment.
This is the question. I agree. So what does this all mean for our outlook?
It doesn't change dramatically our outlook, but we do have to recognize that inflation is still with us and still higher than we all want it to be, and the Fed will have to raise interest rates. I think the Ukrainian-Russian conflict that you talked about at the beginning, that's still with us, is pushing up pressure on energy prices, so that will be a headwind. But we still expect the consumer, particularly in the US, to spend. And that spending should shift from goods to services over time as the pandemic restrictions ease even further this year. So we do expect a recovery in 2022. That does not mean, that's the opposite of recession. We're looking for expansion. And this is in the face of, yes, higher rates, higher inflation, and the geopolitical uncertainty. Those are the headwinds, but we don't think they're going to be as strong or strong enough to push the US economy into recession. It will continue to drive volatility in the market. And we've already seen a pretty significant shift downward in market valuation. And that's a good thing for future returns, as we talked about before. And finally, just a reminder that our portfolios are really designed to weather this storm a bit better because we're tilted effectively toward the smaller, the cheaper, and the more economically sensitive sectors that tend to do well in rising rate and rising inflationary environments.
Thank you, Mark. Great update, as always. If you have any questions or would like to discuss any of the topics we've covered in our webinar updates, please feel free to reach out to Mark or your advisor. And thanks for your trust in Wescott.